Welcome to ChartMill. In this episode, I would like to address an area of trading that many of us are still finding hard. Moreover, it is one of the main reasons why it's so difficult to remain consistently profitable in your trading. And that is to properly manage trades that are in a profit, or to put it in another way, to allow small winners to evolve into big ones. So for example, in a typical trend strategy, the win-loss ratio will be relatively small, 30 to 40%, and the majority of trades will end with a loss. To be successful on the stock market with such a strategy, it is utterly important that you keep your losses small and that your winners are significantly higher, at least enough to compensate for all those small losses, but preferably even bigger to make a return on investment. The big caveat though is that little devil on your shoulder, whispering in your ear that you should take your profit as soon as possible. A lot of traders struggle to let their early profit positions grow into really big winners. Especially when they've had a series of consecutive losers, the temptation is overwhelming to finally take a profit on the next trade as soon as possible. And that's why our stock screener has two useful tools available that allow you to maximize your winners in a 100% objective and rational way. The first one is called the ATR stop. ATR stands for average true range, which is a measure of volatility. It shows you how much a particular stock moves, on average, in a day over a certain period of time, and is adjusted for gaps. The second one is the swing point or fractal stop, which is based on a pattern formed by several consecutive price bars, 5 or 7. A 5-bar pattern stop is a pattern where the middle bar has a lower low than the lows of the 2 bars to the left and right of this middle candle. For a 7-bar play, this applies to the 3 bars on the left and right of that same middle bar. Both indicators are anchored, which means that they can be set directly on the price chart using the right mouse button. In the description below this video, I will provide links to the articles covering both indicators. Let's take a look at some examples. This is the daily chart of the ticker QDEL. In the period from 26 May to 6 June 2020, we notice the formation of a double bottom in a long-term upward trend. The blue upward line represents the 200 simple moving average. Now let's assume that after this double bottom, you had taken a long position at about $170 with an initial stop loss just below the former swing low. This is definitely a reasonable setup from a risk-reward point of view. The next resistance level is at the $210 level. However, if you want to maintain the position beyond that initial resistance, the question arises as to when you will raise the stop loss further, in order to secure a larger part of the realized profit. Both the ATR and the fractal stop can be used for this purpose. First, place the cursor on the level where you want to place your initial stop loss and then press the right mouse button. You will see a menu with several options. If you don't see this menu, press the magnifying glass icon at the top right of the chart. In the displayed menu, you choose Add Stop Here. Next, you can choose between a 3, 4 or even 5 ATR stop or a 5 or 7 bar pattern stop. In this case, I select a 3 ATR stop as an example. ChartMill then calculates the ATR stop based on the currently valid ATR value in the selected time frame, in this case the daily, as we are looking at daily charts. Since we have chosen a 3 ATR stop here, ChartMill will multiply the current ATR value by 3 and keep this distance as a stop below the current price. The stop loss is therefore adaptive, because it always takes the current ATR value into account, but with the restriction that the stop loss can never be set further away than where it was before. For example, if the price moves sideways, but at the same time the ATR rises due to higher volatility, the stop loss will remain the same. However, the opposite, the stop loss becoming shorter when the ATR value decreases, is true. Let's take the Dollar General stock price as an example. In the period June to the end of August 2020, we see a sideways price range and an ATR indicator that is clearly declining. As you can see, the 3 ATR stop does rise slightly during the same period. As the stop loss is 3 times the ATR value, the stop loss decreases and will therefore move closer to the price. Here are some more examples where I have included both the 3, 4 and 5 ATR on the chart. The bigger the chosen ATR stop value, the smaller the chance that you will be stopped out too soon because you are giving the price more room to move. The disadvantage is that many positions that seemed rather promising and yielded a nice price gain at the beginning will be sold with only little or even no profit if the trend does not continue. But once you catch a strong trend, you will be able to profit to the max. For example, take a look at this chart from EPEM. In mid-May, there was a price retracement that brought price close to the 200 simple moving average. At that important support level, we then saw a doji candle and a bullish engulfing pattern, which together are a strong indication of a trend reversal. Anyone who bought shares at that level is fortunate. Even with a 3 ATR stop, the green line on the chart, the position was only closed at the beginning of September. Whoever uses a 5 ATR stop in this case would still be in the market. A few of these big winners are more than enough to compensate for the remaining many small loss and win positions and still be able to make a nice return. In addition to the ATR stop, we also have the fractal stop or swing stop. To make this stop visible on the chart, we do exactly the same as with the ATR stop. First, place the cursor where you set the initial stop loss, then right-click and select the desired option. Unlike the ATR stop, the fractal stop is not based on the ATR value. This type of stop looks for so-called swing levels in the price chart. To recognize these swing levels, ChartMill searches for the lowest candle within a pattern of 5 or 7 price bars. In the 5-bar pattern, the two candles on the left and right must have a higher low compared to the middle bar. In a 7-bar pattern, it should be 3 candles on both sides. Each time such a pattern is defined by the stock screener, the stop loss will be adjusted just below the new swing level. These kind of successive swing levels are typical for stocks in a strong price trend, and this type of stop loss will follow the trend nicely until the price breaks through the last swing level, triggering the stop loss. The difference between the 5 or 7 bar fractal stop is not as big as the difference between the different ATR stops. In many cases, a 5 bar swing level will be followed by a 7 bar swing level almost immediately. But sometimes it can take a little bit longer, and in those cases, the 7 bar fractal stop will stick a little bit longer on its existing level. What kind of stop loss you are using depends purely on personal preference. The ATR stop is no better than the swing stop or vice versa. With the ATR stop, however, the difference between the 3, 4 or 5 ATR is important. In any case, both indicators can certainly add value in managing open positions. Especially if the positions show a strong trend, they can show you that you are not tempted to close positions too quickly. And that brings us to the end of this episode. Be sure to try these two indicators and let me know in the comments section below which of the two you prefer and why. If you like this video, I would really appreciate it if you push the like button. And if you don't want to miss any future video, don't forget to subscribe to the channel. Thanks for watching, see you next time. Trade safe.